So hello, everyone. For those who would like to attend the panel, you can please take a seat. There are a lot of empty seats available for you. OK, perfect. So the timer did not start, by the way. So I think, OK, it did.
Just go for it.
All right. So hello, everyone. My name is Reina Takla. I am the head of the business section at Arab News. Arab News is a Saudi newspaper, both online and on print. We still actually print the papers. I've been in journalism for the last 3 years, and before that, I've been in banking, and I love going back and doing panels and speaking to bankers and wealth managers and the people with all of the money and the power. So today we have the privilege to have with us Bruce Flatt, the CEO of Brookfield Asset Management. We have with us as well Theodore Koenig, Chairman and CEO of Monroe Capital. And you have with us Jack Selby, Managing Director of Field Capital. So welcome, gentlemen, with us, and thank you for being with us. And welcome, everyone, to this panel. We're going to be building up on the previous panel about alternative investments and how their role into in navigating complex land investment environment, given all of the factors that's affecting and could affect investment decisions. So now we have fresh speakers who will add up on their knowledge. As we witness global geopolitical tensions, inflationary pressures, and market volatility, the traditional investment playbook is being challenged. So the way people invest is changing and is going to change over and over again. Alternative assets, once considered a niche investment approach, have gained significant prominence in recent years. However, the question remains, can they still provide the diversification and risk mitigation benefits they promise in today's turbulent environment? So this is what we're doing today. We're going to discuss this topic, and I'm going to directly go and shoot my questions, starting with Bruce. So, excuse me, actually starting with Theodore. Okay. So, with so much talk of an everything bubble, is it still possible to find uncorrelated returns in alternative assets, or have correlation in public markets tightened so much that they are no longer offering any diversification benefits?
Good question. So the PE multiples today in the S&P, 23.5, highest it's ever been. So I'm not an equity guy. He's the right guy to talk to about that. My business is boring, absolutely boring. I'm a debt guy. I do private credit. We do 10% to 12% returns year in, year out. Recession, COVID, financial crisis, inflation, high rates, low rates. One product is private credit. It's been the fastest growing asset class in alternative investments for the last 15 years. It generates stable returns, current return. It's senior secured debt. So from a pension fund, insurance company, anybody that needs long-term, stable, reliable capital returns, private credit's been a good place to be. It's not correlated with the other asset classes, and when things happen in the world, it tends to be a good place to hide out. So that's our business. We dabble in some of the other areas. We'll do some venture debt, we'll do some real estate debt, we'll do healthcare software debt, but for us, the best kept secret is private credit.
Private credit.
That's
and
all.
do you have any specific markets or geographic distribution where private credit is actually giving better returns as private credit? Like, is there any particular areas or geographic countries?
Yeah, I mean, you have to understand credit. The big market is liquid loans. That's ETFs. That's regularly traded, publicly traded debt. Then there's upper middle market and lower middle market. Lower middle market tends to be a little more alpha generating. Upper middle market tends to move more with the liquid markets. So one more is a beta play on credit, one's more of an alpha play.
Okay, I see, I see. Now my next question is for Bruce. As investors' demand pushes valuation higher in private markets, where is the smart money going in 2024 and maybe 2025 and above? And are there any overlooked or underappreciated alternative assets that offer a more attractive risk-return profile in this environment?
So I'll start off by partly answering that, adding to that question. And I would say, the first thing I'd say is that we call them alternative assets today, but in the future, I think bonds and equities that are traded will become alternative to portfolios. And the real reason is that these asset classes of private markets for the last 30 years have proven to be unbelievably positive for institutional investors. Now that's pushing into insurance and wealth, and that's very powerful. And it's diversified portfolios. The volatility isn't as much, and the returns on balance are higher. And that's across all private assets, both real estate, infrastructure, private equity, private credit, and all of these products. And 30 years ago, when I used to go to institutional clients and try to get them to buy into alternative products, they didn't have anywhere to put it. Increasingly today, every institution in the world is pushing money into alternatives, and the ones that aren't there yet will be there soon. And these are becoming very, very large allocations. And look, I think the greatest, so I'd segue into the greatest value today is by private market investors that's been created by the ETF market and the passive index market, because there are, the passive indexes have created stock valuations. Value is here in the markets, and there's many stocks trading here, but there's a whole group of stocks trading down here. And we've done 10 or 12 take privates from the stock market in the last 18 months. I'm sure we'll do 10 more, or at least 10 more in the next 18 months. And it's picking off where the value of businesses is much higher than what they're traded at in the public market. So I think that's the best area, and it's across all businesses. It's in infrastructure, it's in renewables, it's in private equity, it's all asset classes. And it's just the public markets are increasingly offering opportunity for those that have the ability to understand businesses, have enough capital to do it, and to take private those opportunities.
I like the part where you mentioned that bonds and stocks are going to be the alternative investments in portfolios. So I'm looking forward to actually start seeing this and start seeing more and more people being comfortable with investing in alternative
Yeah, so like the leading, Reina, the leading institutions in the world, or many institutions in the world, have 60% of their portfolios today in private markets. I don't think that's alternative anymore.
Exactly.
And we tried to, at the start, we had to, when we created marketing, we had to tell people these are alternative assets, because we had to somehow differentiate them. But private markets, look, generally when people ask me what they should do, and I tell them anything you need for liquidity, keep in some liquid form, whether it's bonds, stocks, something like that. Keep it in liquid form, add to it, because you can't make a mistake, and everything else should be in privates. And I think that's where virtually every institution in the world is going. 20 years from now, the maximum amount of privates will be in every institution in the world.
All right, interesting. Now, Theodore, would you like to add on this question, where the money is going in 2024 and 2025 as well, because we're almost done with 2024.
Where's it being deployed?
Sorry?
Deployed? Where's the money being deployed?
Yes, exactly.
You know, it's interesting. in our business anyway, when I started 25 years ago, the US banking system handled 90% of the loans to businesses. 25 years later, 90% of the loans to companies are outside the US banking system in private credit with institutional investors. Now, the financial crisis had something to do with that. The US regulators decided during the financial crisis that depositors were not going to take future risk of bank failures. So the regulators in the US created a system where there were very high regulatory charges for transactional loans, LBOs, highly leveraged loan transactions. They decided they were going to legislate those basically out of the system. And what's happened since is all of those loans have come out of the system. And they've gone on to balance sheets of insurance companies, pension funds, endowments, foundations, sovereign wealth funds around the world. US did that successfully first. Europe followed. Europe adopted the same regulations that the US banking system did. Now Asia is following that. Loans are coming out of the market to protect the market. And we're going to see a global movement of lending outside of the core financial system to save the financial system. And people ask me, why are you doing more business today? It's the same amount of business. It's just been redistributed away from the central banks and the money center banks of the world.
Well, this raises some pretty interesting discussion topics, which we're not going to be doing here, about what will this mean for the mainstream market and for central banks when all the money is outside and it's moving outside, it's going to be moving even further. How will this impact the mainstream financial system? You know what I mean?
Central banks still play a vital role. Fee income, investment banking transactions, trading income, it's just not loans. Loans clog up balance sheets and create depositor risk. The goal for regulators is to remove depositor risk, and that's what the regulators have done.
And I would just add that private credit, before banks looked at the loans, and the regulator might have looked at the loans, but now these are in funds or on balance sheets of sovereigns, and if they're in funds, you may have 200 people looking at those loans. 200 institutions in the world looking at every one of the loans that he wrote or we wrote. Therefore, the eyes that are on those loans are far, far, far greater than ever before.
Yeah.
Which will actually reduce whatever risks those.
It reduces risk dramatically.
Okay.
So when
It reduces risk to the system, because what happens is the institutional investors are better suited to hold those loans through the cycle. Banks are not suited to hold loans through the cycle. The regulators force banks to mark those loans down, reserve, and move them.
Yeah.
And if you want to create stability in an economy, the recession, the financial crisis wasn't caused by bad performance of businesses. It was caused by a liquidity crisis. It was a bank liquidity crisis where loans were marked down, loans were forced off the books. And what happened, instead of moving those loans at 100 cents, they were moved at 70 cents, which means that banks incurred a 30% loss immediately on every loan. That's what really caused the crisis.
Yeah, agreed on that. Now I'm moving my next question to Jacques before he loses hope.
Okay.
So, vintage year, investing in private equity. Looking back to find undervalued periods is an established strategy. Are there any past periods that offer relevant lessons for investing today, in your opinion? And what does the current climate most represent in terms of its potential to either generate extraordinary alpha or crush the unwary?
Okay, so to disclaim, I'm not private equity, I'm venture capital. So if this is private equity, venture capital is like this, and good venture capital is like this.
All right.
So Bruce manages more than our entire industry, probably in aggregate. arguably. So I can speak about what's going on in venture capital, and so I'll offer you this. Venture capital peaked in 2021. That year, there was something like almost 700 IPOs in 2021. Since then, in aggregate, there have been less than 70. So venture, like most industries, is very cyclical. And so we are in a cyclical downturn in venture capital. And we're not quite halfway there. It'll probably last through the rest of this decade. But essentially what's going on is that there were so many very, very overvalued investments that were made during 2019, 20, and especially 2021. And tech, I think, was particularly impacted because all industries were impacted by essentially the free money that was being printed after the financial crisis. So that lasted for 13 plus years. So we all saw it to some degree or another. I would argue that private tech got more of that money than any other sector because people associated private tech with growth, with yield. And when interest rates are zero, you go reach for yield. So people just piled on more and more into tech. And all these kind of tourists, for lack of a better word, migrated into the space and pretended like they were venture capitalists. So when that happens, it always ends poorly. And so what's happening behind the scenes is that those bad investments, those overvalued investments that were made during that peak of the market period are being triaged behind the scenes. And those companies will fall into 1 of 3 buckets in the sense that they'll either come back to market here soon because they're running out of cash. They'll get marked down massively if they do find cash, which is the best of the 3 outcomes. Second is they get shotgun married or acquired, forced by their VC overlords. Or 3, they go bust. And that process is, if it's a US baseball analogy, it's probably in the 2nd inning. So it has a long way to play.
Now, you said there's upturns and downturns, and now we are in a downturn for venture capital. What do people do in this kind of periods? They just wait around, or they get out of their investments, they panic, they just have a coffee? What do they do?
So right now, the data is hard to come by, but let's say there's roughly about 9,000 global venture funds. That number, when it's all said and done, probably goes below 3.
Oh, yeah.
3,000.
Okay.
So what are these guys doing? So these folks, they deployed all their capital back in 19, 20, 21. Those investments are massively overvalued. They haven't adjusted their marks. They haven't given any capital back to their investors. There's no way they can go raise money again. So what do?
Find another job.
Well, they start throwing all these Hail Mary passes, trying to get these companies hopefully back on track. And even if it's a low probability play, say it's a 5% play, like in the Washington, the Redskin Bears game this past weekend, even if they can hit it, it's worth playing because otherwise they have no capital to play with, and all they're doing is essentially milking management fees from their LPs.
So was there an opportunity today? It sounds to me like an opportunity to come in and buy cheap.
So 2 things. Venture is different than private equity in the sense that if you're Chainsaw Al Dunlap and come in and say, I'm going to fire everybody, cut this to the bone, take out some debt, and get this thing back on its feet, the venture mentality is say, sorry, Chainsaw Al, here are the keys. I'm going to go reconnect with my Stanford roommate from junior year and dust off that business plan that I wrote and go start the next SpaceX. Because I'm not going to work for Chainsaw Al for the next 5 years to get back to a fraction of the valuation that I thought I achieved 5 years ago. So all that being said, to be positive, because I don't want to sound overly negative, this point in the cycle, though, is when the next PayPal or the next Google, really, if you look at it, the top tech companies get started at the bottom of the cycle. And we were talking before, VCs can talk about all the skill and how that's the determinant variable of their performance. It's actually not. It's when you deploy into the cycle. And because we're at the low point of the cycle, this is a great time to invest.
So, Reina, what do you do? We had never invested that much money into the venture space and growth space, and we just bought Silicon Valley Bank's business, their asset management business, out of bankruptcy when it went bankrupt, and we're putting significant money behind doing secondaries and supporting those businesses, the great ones that don't have capital. Yeah. So what happens in these periods of time is new capital comes in, some sponsors go away, there's a consolidation that goes on, and the business starts over again. And I would say it's the maturity of an industry, because what's happened in every single one of these industries, this time it being venture and growth, is there's a huge consolidation. Sometimes consolidation is people just go out of business, but a huge consolidation into less players. And that's where the money goes globally. And in fact, I would say it's positive for the industry because the successful ones succeed, the amateurs go out of business,
Yeah.
and the investors end up with better partners in the fullness of time.
What we've seen is it becomes a liquidity issue more than anything else. There's good companies, good business plans, good technology, but there's a liquidity issue because of what we talked about. Investors won't put money in because the last valuation round was so high, the board members and the existing investors won't take the money at a hugely dilutive round because they have to mark their book then down at the last round of financing. So these companies that otherwise would be good companies that have good technology sometimes become orphaned and they become basically liquidity starved.
Yeah.
So in our business, for example, we have a venture debt business. We'll come in and do a high rate of return venture debt and take collateral of the company or do a first piece of liquidity debt without being dilutive, because that keeps everybody in the game and it keeps all the venture guys at the table. They don't have to walk away or write off their investment. I mean, what are you guys doing for your good companies for liquidity right now?
It's tough. I mean, it's like a Sophie's choice. So you have some companies that you're still going to support and some that you have to let go. And so, we were talking about the mark. So I would predict that finally at the end of this year, the big auditing firms are going to go sit down with their family office friends because whenever family offices try to bypass their VC friends and go direct in the market, that's one of the best predictors of a top of the market. And you saw a ton of that in 21. And so these folks, these family office folks that came in directly, they've been holding on for dear life to these marks, even though the public comps are trading at a fraction of what they are from back in 21. So why are these marks being held? It's career risk. These guys don't want to get fired. But when E&Y comes in at the end of the year and goes into the big New York City family office and says, listen, you have to mark this down or you don't get the fairness opinion, then that's when the mark has to get readjusted. But to the point earlier that Ted made, and Bruce, you made this as well, it's a healthy process. It's a Darwinian, cathartic process. There were so many B- or worse funds that came into existence. They made a lot of B- or worse investments. That's fine, it's capitalism. They just need to wash out. So the engineers from Stanford that are working at the dog walking tech company, they need to stop working at the dog walking tech company. They need to leave. They need to go start the next Google or the next PayPal, but they still think that the valuation is circa 2021. It's not. And when they have that—
They're holding on to that.
Yes, so when they have that wake up moment, that's when they say, okay, sorry boss, I'm out of here and I'm going to go start the next Google.
See, I think the greatest area right now of mispriced assets in institutional portfolios is venture debt, because I don't believe the general partners have taken the marks on their portfolios, and the second worst place is in private equity. The problem in credit, my business and your business, it either performs or it's not performing. You can look at that and you can identify whether a company's performing and take a mark on that. The challenge with venture debt is that I don't believe any of these portfolios have been marked properly. And there's going to be a reckoning, and there's going to be a big reckoning both in private equity and in venture capital, and that's going to change the valuations of a lot of the portfolios, whether you're an insurance company, a pension fund, or a sovereign wealth fund. And all of them right now are closing their eyes. Nobody wants to open their eyes to the real value of the marks.
All right, so I just want to ask one more question because we're running out of time, and I would love to ask this question to Jacques. How do you see the dynamics here in Saudi Arabia with regards to venture capital? There are so many things happening, a lot of news on this side. Would you have any plans or thoughts of going into the market here in Saudi Arabia?
So the market in general in MENA and in Saudi in particular, there's obviously tons of capital here. There are plenty of venture capitalists here locally on the ground, which is great, because it's kind of a field of dreams mentality. You have to build it and then they will come. So you've built in the sense that you have plenty and plenty of VCs here. Am I going to be the smartest guy in the room, going to parachute in from Los Angeles, land in Riyadh and pick off the best deals? Probably not. I don't speak Arabic. I don't live here. So I'm very interested in terms of the progress that's being made. And I would love to potentially come in and be a follow-on later stage investor. But we're early stage investors. And so the idea that, again, that I can come in temporarily and identify the best deals and have an edge, so to speak, I don't think that works.
I see. Bruce?
So we've been in the region for 20 years. We have 30,000 operating people here. We have big investment offices, and we're announcing a MENA fund shortly.
At FII?
At FII.
Okay. Getting a scoop now.
And we are going to be investing significant amounts of money in the kingdom. And look, I think all of our businesses have benefited enormously from growth in this region. It's been one of the fastest growing in the world. It's pegged to the dollar. And the amount of things that are going on are very exciting. So we're bringing many of our businesses here.
All right.
And we're going to continue to build out across the board.
Perfect. I don't think we have enough time to ask any more questions. Gentlemen, thank you so much for your insights. This was very wonderful and very insightful indeed. And we'll see you around then.
Okay.
All right.
Thank you for
you
having
everyone
us.
Thank you.
Thank you for listening, everyone.
Thank you.